Hello everybody out there, this is Roy Carter from Rectitude Media, and I thought I'd do a video on the emerging economic collapse. I mean, just look at what's happening in Greece, Puerto Rico, Venezuela, and now China, with the Shenzhen losing 40% in just a couple of hours. Mind you, some of that was recovered, but that's still the biggest mini-crash since 2008 for crying out loud. As soon as that happened, the New York Stock Exchange shut down due to a computer glitch. Now anybody who can put two and two together can see this is a desperate attempt to stop a panic. How does this affect things globally? Well, Australia relies on the Chinese economy for 30% of their exports. China's efforts to cut interest rates for the fourth time this year by having to dip into their own state funds and severely restrict trades to balance things out. Let's not forget the fact that China has put out 7% growth targets and met them with all of the economic stress they've been under. This brings light to the question, can we even trust the economic data of the Chinese government? I mean, take a look at this chart tracking GDP growth with both official and annualized quarter-by-quarter analysis, and you can see the discrepancies in their announcements. It is an official charade because China's GDP has long been recognized as a distorted measure of the country's economic growth. The value created in the country's economy is inflated by the stuff bought and built in China, and that stuff's not even worth the official sticker price. This is thanks to the government's implicit guarantee of any investments that are political priorities. This gives investors, both corporate and individual, the confidence that the government will bail them out any inconvenient losses. It encouraged banks and individual savers alike to lend to wasteful projects, as long as an official imprimatur is looped in somewhere. It lets lenders accept these unprofitable projects at face value as collateral for more loans. What is the result of this wasteful policy? More debt. China has nearly quadrupled its debt from 2007 to mid-2014, and let's not forget the past fabrications of GDP figures. The most notorious case of manipulation came in 1998, in the aftermath of the Asian financial crisis. Many Asian countries suffered recessions, but China claimed to grow by a hefty 7.8% that year. Looking at other indicators, many economists concluded that growth was in fact closer to 5%. The manipulations can occasionally work in the opposite direction. In the early 2000s, when China reported growth of 8 to 9%, some reckoned that it was really expanded by closer to 10, possibly even 11%. Now, why would China understate its growth? One possibility is that statisticians miss big parts of the economy. Another is that the government downplayed its strength to avoid arousing anger at a time when its export juggernaut was beginning to rev up. Yet China does have a few trump cards in their hand. They have control over their own internal economy. They have a whole new source of potential long-term revenues with the BRICS Bank, and the world may be in for quite a shock when China reveals how much gold they're really holding in their vaults. The Chinese currency, the yuan, will likely be added to the basket of reserve currencies that comprise the IMF special drawing rights, also known as SDRs. IMF officials at the very top said that the yuan could be part of the SDR because of China's heft in the global economy and its position as the world's largest trading nation. China ultimately reports 3,510 tons of gold. That's the estimate of China's gold holdings that's currently floating around the media. Now, if that turns out to be a true figure, it would be more than 3 times the 1,054 tons of gold that China last reported officially in 2009. Many believe it could be more than that, based on the quantity of gold China mines each year. It is the world's largest gold producer, after all. And on the reported quantities of gold flowing into the country through Hong Kong and Switzerland, it's calculated that China more realistically owns somewhere between 5,000 tons and as possibly as much as 11,000 tons of gold. Such a quantity would shock the world paper gold bond markets because, primarily, it would raise enormous questions about where China collected all of this wealth and gold. It would be a very clear indication that China is establishing the yuan as a competitor to the US petrodollar. Lots of Western commentators will laugh at that. A communist country with a reserve currency? Well, they're not laughing that much anymore with the development of the BRICS banks. They are so blinded by historical norms, the dollar's reserve currency status for the last 70 years, that they fail to accept that history is ever changing. The status quo is always in flux. It would also be a clear indication that gold isn't an archaic form of currency. It's a very modern currency, one that serves a very real and useful purpose today, as disaster insurance. It's just that it's a form of currency that government finds really hard to manipulate, which explains why U.S. monetary officials routinely pan the metal as essentially useless. The rest of the world sure doesn't seem to feel that way. They see gold as a financial asset that has been used for thousands of years, which is why nations like Germany, Switzerland, Austria, Belgium, the Netherlands, France, and even Texas is trying to repatriate or looking to repatriate their gold. Their national gold held in the Federal Reserve and the Bank of England. China's report to the IMF, when it comes, will be the next big event to highlight the importance of holding gold today. The message remains crucial to your financial well-being. Buy gold. Buy it often. Stash it away wherever you deem is a safe place. Just not a bank's safe deposit box, because they are going after those in certain countries. And sit patiently. The world is on the verge of a golden shock that will redefine global power, and likely send gold prices marching higher. What significance does this have to the rest of the world? Well, due to their fiscal irresponsibility with quantitative easing, fractional reserve banking, and rampant market manipulations, the debt-to-GDP ratio for the entire world is now at 286%. That's $28,000 of debt for every man, woman, and child on the entire planet. And since close to 3 billion of those people survive on less than $2 a day, your share of that debt is going to be much larger. I can tell you that. If we took everything that the global economy produced this year and everything that the global economy will produce next year and use it to pay off all this debt, it still wouldn't be enough. According to a recent report put out by the McKinsey Global Institute entitled Debt and Not Much Deleveraging, the total amount of debt on our planet has grown from $142 trillion at the end of 2007 to $199 trillion today. This is the largest mountain of debt in the history of the world, and those numbers mean that we are in a substantially worse condition than we were just prior to the last financial crisis. When it comes to debt, a lot of fingers get pointed at the United States, and, well, rightly so. Just prior to the last recession, the U.S. national debt was sitting at about $9 trillion. Today, they've managed to double it to the $18 trillion mark. But of course, the U.S. is not the only one that is guilty. In fact, the McKinsey Global Institute says that debt levels have grown in all major economies since 2007. The following is an excerpt from the report. 7 years after bursting of a global credit bubble resulted in the worst financial crisis since the Great Depression, debt continues to grow. In fact, rather than reducing indebtedness or deleveraging, all major economies today have higher levels of borrowing relative to GDP than they did in 2007. Global debt in these years has grown by $57 trillion, raising the ratio of debt to GDP by 17 percentage points. That poses new risks to financial stability and may undermine global economic growth. What is surprising is that debt has actually grown in most of China. If you can believe it, total Chinese debt has grown from $7 trillion in 2007 to $28 trillion today. Needless to say, that is absolutely insane. What all of this means is that our long-term global economic problems have gotten much, much worse. This short-lived period of relative stability that we have been enjoying has been fueled by unprecedented amounts of debt and voracious money printing. Anyone with half a brain should be able to see that this is a giant financial bubble, and in the end, it's going to unwind very, very painfully. The following comes from a Canadian news source. At the beginning of 2008, government accounted for a smaller portion of the debt pie than corporate, household, or financial debt. It now exceeds each of those categories. The current situation is much worse than in 2007 or 2007, and with interest rates near or at zero, the central banks have already used up their ammunition. Plus, the total indebtedness, especially the indebtedness of governments, is much higher than ever before, said Klaus Vogt, a Berlin-based analyst and co-author of a 2011 book titled The Global Debt Trap. Every speculative bubble rests on some kind of a fairy tale, a story the bubble participants believe in and use as rationalization to buy extremely overvalued stocks or bonds or real estate, Mr. Vogt argued. And now it is the faith in the central planning capabilities of global central bankers. When the loss of confidence in the Fed, the ECB, the IMF, etc. begins, the stampede out of stocks and bonds will start. I think we are very close to this pivotal moment in financial history. But, for the moment, the ridiculous stock market bubble continues. Internet companies that didn't even exist a decade ago are now supposedly worth billions upon billions of dollars, even though some of them don't even make any money at all. There is even a name for this phenomenon. Internet companies that have gigantic valuations without gigantic revenue streams are being called unicorns. Yes, unicorns. A dizzying mix of bold ideas and lavish investments has catapulted dozens of privately held startups to unicorn status. Unicorn! Defined as having market valuations of at least $1 billion, often without soaring revenues to match. Social sharing site Pinterest has soared to $11 billion, while ride-hailing company Uber is now worth a staggering $50 billion. How long can the party last? And these days, Wall Street even rewards companies that lose huge amounts of money quarter after quarter. For example, just check out what happened when JCPenney announced that it only lost $167 million during the first quarter of 2015. JCPenney only lost $167 million in the first quarter. The Wall Street shysters were ecstatic because they beat the expectations of how crappily their company was going to do. So they bought and they bought and they bought. This loss now brings JCPenney's cumulative loss since 2011 to $3.5 billion. They haven't had a profitable quarter in over 4 years, but they are always on the verge of that turnaround just over the horizon. Wall Street has told you to buy this stock from $42 in 2012 to its current pitiful level of 9%. They tout the wonderful 3.4% stock increase in comparable sales. They fail to mention that first quarter 2016 sales are only 30% below first quarter sales in 2011. They fail to mention that JCPenney burned through another $274 million of cash in the first quarter. Their equity has dropped by $1 billion in the last year, while their long-term debt has gone up by $500 million. This is how irrational Wall Street has become. JCPenney is ultimately going to zero, and yet there are still people out there that are pouring large amounts of money into that financial black hole. I mean, look at what's going on with McDonald's, having to close hundreds and hundreds of restaurants across the states, and even trying to jazz up the existing McDonald's that they have in different areas and locales. It's all strategic. Sadly, the truth is that Wall Street is headed for a very painful awakening. What we are experiencing right now is the greatest financial bubble of all time, and what comes after is going to be the greatest financial crash of all time. I mean, $199 quadrillion of debt. Not millions, not billions, not even trillions, quadrillion, is about to come crashing down, and the pain of this disaster will be felt by every man, woman, and child on the entire planet. Look at the decline of middle-class incomes and the second chart's net worth of incomes adjusted for inflation. It's getting damn near impossible for the middle class to survive nowadays. We have a global economy that bails out the mega powerful companies while stifling small businesses owners that can't compete, and they aren't given the same protectionary measures that subsidized industries are given. Let's not forget the incredibly bloated housing bubble here in Canada. A National Post article clearly shows that U.S. short sellers are betting on a housing crash in Canada. The very same crooks who profited from insider knowledge of the collapse in 2008 are now betting against the upcoming crash in major Canadian cities. The hedge fund investors, known as short sellers, are betting against what they believe is a housing bubble in Vancouver, Toronto, Calgary, and other Canadian cities. They believe Canadians hold too much mortgage debt, and that Canadian banks, mortgage insurers, and subprime private lenders will lose money on unpaid loans when property prices fall. The cross currents are beyond crazy in Vancouver. It's a mix of money laundering, speculation, low interest rates, said Mark Cohodes, once called Wall Street's highest profile short seller by the New York Times. A house is something you live in, but in Vancouver you guys are trading them like penny stocks on House Street. He says, Vancouver real estate has reached peak insanity, and any number of factors could trigger a collapse. Local real estate professionals predicted the U.S. investors are likely to lose their shirts betting against Vancouver property, which they described as a special market thriving on international demand. The one Canadian housing analyst who advises U.S. clients, including Cohodes, said major investors are currently building positions against Canadian housing targets. They are forecasting a raise in historically low U.S. interest rates this fall, and whether or not that comes to fruition, it will spill financial stress into Canada. All of the big global macro funds that were involved in betting against the U.S. in 2007 and 2008 and even 2009, they've all studied Canadian housing for a few years, said the Canadian analyst, who asked not to be named because of client confidentiality. I know a number of them are shortening Canadian housing. It looks like an accident waiting to happen. This is although housing markets in Vancouver and Toronto have continued to rocket higher since international short sellers started circling in 2013. Short sellers use complex financial arrangements to make rapid profits when publicly traded stocks fall in value. In this case, they are betting against businesses connected to property and household debt. They are also betting against the Canadian dollar because they believe it will decline significantly in a housing burst. Most of these traders are employed by secretive New York investment funds that shy away from publicity, partly because they don't want to disguise or show how they lay their bets. A few, though, like Cohodes, take the opposite approach. He has come out of semi-retirement on his chicken farm in Northern California to make targeted bets against subprime Canadian lenders, who make loan to borrowers rejected by traditional banks. The Canadian housing analyst noted short-selling bets against big Canadian banks have doubled in New York markets in just the past several months. That is not a good sign. That means they're ramping up and getting ready. And the risk of having a sharp housing correction connected to Canadians' high household debt has risen since December, the Bank of Canada recently reported. Even their attempt to lower interest rates may have came a little too late for it to do any good. While short sellers point to Vancouver as the most extreme housing bubble in Canada, the analyst noted that some investors believe a massive flow of investment from mainland China makes the market impervious to corrections. Others speculate that if the Chinese economy slows dramatically, which is what it's doing, the Vancouver housing bubble will burst. Combine that with the slumping oil prices, and we are at a very scary economic crossroads. I'm going to be doing a bunch of economic videos on this subject, as it's extremely complex and there are many different components to it that keep coming out every single day. I'll be posting links in the description below to the graphs, figures, and articles that I use for information. And feel free to subscribe or stay tuned for more videos that I will be doing on a country-to-country basis. I kind of did a generalized talk on China, because that's what I kind of wanted to focus on mostly this video. But I will be doing one on Greece. I'll be doing one on mainly on Canada, especially with the fact that Mark Carney kind of inflated our bubble and then went off to the Bank of England and then left Stephen Poloz to, or as I call him, Stephen, there's nothing to see here, Poloz, to deal with the mess. So I will be doing that very shortly. Thank you very much for your time and support. And a channel I highly recommend is the X22 Report. They do a really great, well, I think his name is Dave, I believe, but he does a really great job at explaining it step by step, and he's put a lot of videos out. And his videos are usually up to date, and you can tell he spends a lot of time putting his videos together, which I think is really awesome. Another shout out I'd like to give is Press for Earth. A gentleman named Kyle. He just started out. He's got some great videos. I think he's doing a great job, and look forward to seeing more videos from him too in the future. So yeah, thank you very much to everybody out there. Another one I also recommend is RT's The Kaiser Report. Max Kaiser. He can be a little bit of irate psychopath sometimes, but he gets his point across. He's just thinking like the big fish do, and telling regular people like you and me exactly what's going on. Also, Fabian for Liberty is also a very good channel, and yeah, he's got a lot of great things to say, even though it's mostly from a U.S. Perspective and a lot of aspects of it, but it's good to have those views around. Anyways, thank you very much. This is Roy Carter from Rectitude Media, and keep on rocking in the free world, for as long as it's free anyways.